This is Real Estate 360 with best-selling author, international speaker, and HGTV House Hunters guest expert, Kenn Renner. In this episode, Kenn will share with you his personal Rich Dad, Poor Dad story, what he means when he says get rich consistently, and what it means when the mainstream media starts talking about the housing market. That and more in this episode of Real Estate 360 with Kenn Renner. Kenn, you've been doing this a long time, 35 years in real estate sales and investing, 25 years in Austin sales and investing. You've closed over $400 million, one of the top investment brokers in Central Texas. Also, just to add to this impressive resume, a best-selling author, an international speaker, and I think most people probably recognize you most as being a guest expert on HGTV's House Hunters.
Sandy, I really appreciate it. Thank you for having me on the show here. This is going to be a really great adventure in real estate. Our mission here is to help make dreams come true through real estate and home ownership, and have fun doing it. As we were just talked about this before the show, that's real estate can be quite a challenge, and buying a home, even just buying one home, is like a new part-time job.
I've always think as the buyer is someone that is making the biggest investment of their life with the least amount of knowledge.
Yes, absolutely. It is one of the biggest, and that's why we do a lot of education. And I mean, it is the biggest investment. Just the first home that you are buying is a huge investment. But as you go through the years, if you're buying and selling more, I mean, that's how a lot of our, how people get into higher priced homes, as because they've owned a home and they were able to sell it. But, basically I was looking at the fact that home ownership and buying homes turns into be, if you hold on to them for the long term, turns into be an amazing investment. Even if you just bought that first home, that first one-story home, 1,500 square foot, and held on to it rather than selling it, and it could be it'll be paid off. By the time you retire, it'd be a great additional retirement income, or it'd be a good a thing that you could sell that's free and clear now. And so that's kind of the stories that I'm going to tell, some case studies that we've had even in my own life. And we'll try to keep our shows down to 20 minutes, because I know people are busy, and that's our clientele. They're either busy, hardworking people here in Austin, Texas, or they're out in the Bay Area or Southern California or New York or Virginia, and they want to get answers about our hot market here. So the show's called Real Estate 360 because we want to cover all of our bases. It's focused on investing, but even that first house that you buy is an investment. So our two areas of the market that we focus on. And we hit all areas of the market, but our focus is first-time home buyers and real estate investors, residential real estate investors that want to get into the market. It's not that easy to get into large multifamily. It's not that easy to get into real estate syndications, more like a stock, and but it's pretty relatively easy to buy a home or keep that previous home and rent that one out, and then build a portfolio of long-term passive income based on the growth of not only the equity buildup, but also through the appreciation, but also the loan balance going down. So just since I've been doing this so long, and I'm an investor myself, we're really focused on the education, building and having a team around for our investors to be able to feel secure that they can put their head on the pillow at night and know that they have a turnkey operation, that they know that they're not worried about toilets. What is it? The 3 T's: tenants, toilets, and termites. So yeah. So I want to just kind of introduce the whys to invest in real estate very quickly, but then I want to entertain about 7 or 8 minutes about my own Rich Dad, Poor Dad story. Part of why I should invest in real estate, where should I invest in real estate, how should I invest in real estate, and who should I trust to help me? These are the big questions. And for our most of our clients who are very, either they're high-tech workers or whatever, they just don't have a lot of time. So the first thing we do is we try to help people realize it doesn't take a lot of time if you get connected with the right team. Effort. This is it's like I said, it's a new part-time job, especially becoming an investor. To build a portfolio of real estate, you have to get with somebody who's going to educate you and coach you, and that's what we do. Our team handles all of the hassles, and so it's turnkey investment. And like I said, most of our clients will come out and buy one just to test the market and test our team and test our philosophy, and then they'll come back and buy another one, or they'll tell their 2 friends and they tell their 2 friends. So time, effort, and then money, and that's the whole thing. The entry level for our homes here in this area is very low. It's low as 15% on an investment, and for those are owner occupied, zero total move-in. So those are it's a great time to invest in real estate, and we've been on the biggest economic expansion for the last 40 years. Has been the last 10 years, but that's only because we had such a big deep recession that we had the Great Recession, and that taught a lot of lessons about the mortgage market and things like that, and also really based on the stock market. But so real estate offers a really nice bundle of benefits. First of all, it offers income if it's a rental property. It offers the tenant obviously pays the rent, so it offers you the income. They're actually paying that mortgage balance down. It offers cash flow from that income as well. If it's for our investments, normally the payments $1,000 or $1,000 a month or whatever, and they're getting $1,500 a month rent. So they're getting a positive cash flow. So not as only is the tenant paying it down, but they're also getting a positive cash flow. The next one is tax benefits, and we could do a whole seminar on just tax benefits and the depreciation alone. But the tax benefits are huge. The more real estate you own, the bigger the tax benefits. And then leverage. Leverage is that you only have to put 20% down or 15% down to buy an investment property. That's leverage. So if it goes up, the property value is $200,000, and you put 10% down or 15%, or say 20% down, that's $40,000. If it goes up 10% or 20%, then that $40,000 you put down is now 100% profit. It's a doubling of your money. So that's one of the great things that real estate offers is leverage. And then, of course, the equity buildup over time, appreciation. And then the estate disposition. There's some great benefits on passing to a legacy. And that's kind of what I want to talk about today, is the legacy that we could leave behind. So I ask a lot of my investors, I say, well, why are you investing? Okay, obviously for the very real possibility that you could have financial freedom. And that just means that, as you know, it means that the income from all your properties is enough to cover all of your expenses, so that you don't have to work. And a lot of my Bay Area folks they're kind of getting really, really tired of the rat race. My Orange County folks and LA folks are tired of the traffic. We have our own traffic problems here in Austin, but it's easy to get away from. 30 miles from Austin is like in the middle of nowhere, right? Talk about the legacy, my rich dad, poor dad story. So this is my true rich dad, poor dad story. And it was written by, obviously the book was written by Robert Kiyosaki, probably the #1 real estate book of all time. But also Sharon Lechter, who's a friend of mine. Sharon Lechter, I've spoken with her on stages. I've sponsored her events and things like that. Sharon Lechter was the CPA. She was the financial mind behind Rich Dad, Poor Dad. So, but let's start with that, because I was born in 1963. My dad had moved out of the military. He moved out of Germany was where he was stationed. He didn't want to have his child in a foreign country. I kind of would have liked it. I would have dual citizenship, but so he flew. They flew the family back. I was born. We moved to California immediately, and we moved to a little town called San Mateo, and he bought his first house for $17,000 for a VA loan, because he was a veteran, and so VA loan $17,000 in 1963. That ages me. I'm 55 years old. So 55 years ago, $17K. He sold it a few years later for $25K. He got relocated, and he thought that was a pretty good deal. It's probably not a bad deal. Buy it for 17, sell it for 25. So I look back at that one house, and in fact, it's funny. I went down memory lane and actually found the exact house. And so on my webinars, I actually show my very first memories in this house. But as you can see, Sandy, it's like, this house has got wood paneling, and it's got the white appliances. Nothing's been upgraded. But I'll tell you, this little house on Lexington Lane that my first memories where I was born is now worth $1.6 million in January. $1.6 million.
And I'm sorry, how many years back was that?
Now that's 55 years.
55 years.
It's
wow.
Basically 100x.
That's what I was about to ask. Yeah.
It's 100 times. So,
2 times a year.
It's amazing.
Wow.
It's amazing. Now, so I'm looking at this house. I'm going, if my dad had just kept that one house, he would have been an accidental, almost multimillionaire. I call it, and in my book, my Home Buying Secrets book, I talk about the accidental millionaire. He just could have held that property, and then it would have been paid off, right? 30-year loan 15 years ago, and it would have been, he could rent that thing for $6,000 a month, or sell it and 1.7 million, or leave a legacy for your kids.
Right.
So, over the years, he moved to Palos Verdes, which is another really awesome suburb in California, very high priced now, wasn't at the time. I think he bought the next house for I think it was $48,000. And I tracked that one down too. And it's kind of neat looking at the tree I used to climb out in the front yard, But that house now is worth $1.2 million. So that got me thinking, what if I went back and all the houses, and of course he sold it and we moved again. What about all the houses we moved into and sold and then leased and then moved into and sold and then leased, if he just kept all of them? Mm-hmm. And it was like the incredible value. It would be worth over $10 million and it would be free and clear. Wow. Just the houses we moved into. We're not talking about investments.
Right.
So, the unfortunate thing about that is, or the fortunate thing is that he ended up at the end of his life not owning any real estate, and because he had sold it all, and through those years, I basically took care of him for the last, paid his rent and everything for the last 3 or 4 years of his life, which was an honor to do. But it was I don't think it was where he wanted to be at that point. He wanted to leave a legacy for his kids and things like that, and live well. He was always worried about money. So I kind of, that's my personal journey on this, like the motivation. Why I'm like, okay, why do I want to build and have built a portfolio of real estate? Because I want to live a good lifestyle, but also want to leave some properties for my kids. So I talk about my rich dad. My rich dad is actually my father-in-law, who's still alive. His name is George, and he's part of our team, and he's the patriarch of our team. And he started buying homes probably about the same time my dad did. He's 80 years old now, so started buying homes at the same time, about in the 60s, mid 60s. But the difference was he kept almost all of them. He kept them, or he did what's called a 1031 tax deferred exchange and bought more. So he also was buying in California, but eventually around the 90s, about the late 90s or early 90s, we started going out and looking. Well, let me tell the story is that I was living in California at the time in the 80s, and there was a boom going on. And from 84, 85 till about 1990, there was a huge appreciation, a huge boom. But by 1990, I finally had some money in my pocket to be able to invest, because it seems that us in real estate and loans, we make all our money towards the end of of the real estate cycle. So I finally had some money available to invest, and I asked my rich dad, who is my father-in-law to be, so where should I invest? Should I invest here? And he's like, no. And he goes, why? And I said, haven't you seen the paper? We're at 8% affordability factor. It means only 8% of the people in this county can afford a medium price house. So that is an indication that there could be a potential adjustment of prices. And sure enough, in 1990, from 91 to 97, they had the 30 to 40% drop in values in Orange County, where I was from, that's just south of LA.
Wow. So
that's huge. And so, but fortunately, I followed that pattern and saying, I don't want to invest in an area that has a potential where I could lose all my money, right? Because of the natural fact that it's overpriced because people can't afford it. So we started looking around the nation, and one of the things that I saw was a National Geographic article way back in 1990 that said "Deep in the Heart of Texas," or "Deep in the Heart of Texans" was the name of it. Then right after that, Money Magazine came out with the best places in America to live. And Austin was always has been on the top of that list. So we went out to Phoenix, looking at Arizona. It was a little too hot for us, too little deserty for us. We weren't sure if that's where we wanted to be. Looked at Vegas. I guess any of those areas would have been good to invest way back then, right? And then we looked at Orlando, and that would have been probably a good place to invest as well. But then we landed in Austin and decided that's where we're going to go. So we went to Austin. Our first trip here, I bought 3 investment properties. It was like a kid in a candy store, and that's kind of the fun that I have when my investors fly out here. It is like a kid in a candy store. I bought 3 houses for $70,000 a piece. Non-qualifying assumption, didn't even have to run a credit report. It was back in the after the 80s crash of the whole oil crash and real estate crash, and so people, they were just giving houses away, really. So $5,000, no questions asked, you own the house. So flash forward, I was through the 90s, the values certainly went up. And so I started noticing once again a pattern. And my dad taught me these. My poor dad, who was was a real estate attorney, he was the one that taught me these, to be observant of the cycles of the market. And so on the next podcast, we're going to talk about the cycles and the counter cycles, and why you can or how you can take advantage of the disparity between different areas of the market, which is when there's an overpriced situation, an overheated market, let's say in California or New York, and we're kind of chugging along. There's probably we're going to have bigger swings on the coast. Things go up faster and further, and they drop further and faster. So I don't know if we've learned our lessons from the last great recession, but most of the values in California, many areas dropped as much as 40 and 50%.
Currently?
No.
Oh, okay.
They're
Back then,
up 100% from there.
Right.
But that's dangerous to be 100% up. Now, I mean, over time, obviously, like the house in San Mateo that my dad bought, I mean, if you hold it over time, that's great. And, don't sell it and hold it a long term, you're going to be fine. But the swings in the market are much higher. And so there's a bigger chance of losing more of your equity during downturns in the California market than there is in Texas. And we have some charts when I do my webinars. I show charts. Texas is a much more stable market, doesn't have those huge run-ups, but it doesn't have the big drop-offs as well. So, coming fast forward, I saw that trend. 97 was the bottom of the market in California as far as housing, and then Austin was booming because we had Dell computers and we had the .com thing going on. But by 2000, that kind of petered out, right? So I saw that the Austin market kind of just leveled out, balanced out, and they just were starting to slow down on sales. And that values didn't really drop a whole lot. They just kind of leveled out. California started going through the roof. People buying and flipping, and things were going up, and the free, easy, greasy mortgage money, which got easier and easier through the 2000s. I mean, it got ridiculous with the no income, no asset, no job. That was a ninja job. No income, no asset, no job, no verification of nothing.
Are there any indicators for the Austin market right now that are telling you anything good or bad? Is there a correction coming? Are houses overpriced now?
Gary Keller of Keller Williams used to work for that organization for many years, spoke on their big stages about real estate and marketing. He said that it's not if, it's when, or not if, it's when with any market.
Sure.
But the good news is that, okay, so I'll give you my example of why I wasn't following the market, wasn't paying attention, because in the early 2000s, I started going to California. I was telling people, get your money out, and about 700 investors bought homes from me. I was, sold over top of the Austin Business Journal for residential real estate because of that. And everybody was loving it, right? But by 2006, that was where they had in California an article that there was 17% appreciation in one quarter. In one quarter in Southern California, 17% appreciation. I'm like, this is not sustainable, folks. Get your money out now while it's there. And so 700 people did, but probably 7,000 people wished they had done that.
Right.
And so, but I was doing really, really well. And what did I do in 2007? I went and bought a $1 million house on the lake with $1 million loan, right? It was 10% down, I think is what it was, and no income, no asset verification. I qualified, but it was like I gave them an application and a check for the appraisal, and they gave me $1 million. I was like, guess who gave me that loan? Countrywide Lending, who's no longer in business. So I bought that house, and of course, the recession hit. People stopped buying real estate as investments, and everything kind of just leveled out. And of course, my real estate volume and sales went way down, but I still had this big house with this big mortgage. And the thing is that we couldn't sell it, right? Because no one was buying $1 million houses at the time. So I had to maintain the lifestyle that my family had come accustomed to. I started selling some of my rentals. And I was able to because the values of the properties here in Austin and the medium price and below, which is where we do those rentals, did not drop. It just leveled out. Volume dropped substantially. So we went from 27,000 sales to 27,000 down to about 12,000. It's like 1/3 the volume, but the prices kind of just bounced along. So I was able to sell some of my investment properties and free up equity because it was there, and be able to pay for my expenses during the Great Recession as we went through.
Which is kind of a nice thing to have as backup, although further down the road you probably wish you didn't have to sell them.
Yes.
But At the time, it was a nice safety net.
It was, and that's the thing is that if you were invested in an overpriced area that it would adjust 20, even if I had put 20% down and it adjusts 30%, I'm underwater by 10%. I'm going to walk away, and that's exactly what happened during the Great Recession. Values dropped extremely all over especially on the coast, extremely huge drops that people were buying homes with very little, like remember zero down ninja loans
and walking away,
and they just walked away, and that caused the tumbling of the market. Now here's the secret. This is something I tell my clients. This will be something to be aware of. If it hits the news that prices are dropping or volumes are going up or inventory, if it hits the Orange County Register or the San Francisco, the Chronicle, if they start talking about that, becomes a problem with the mentality of a market, and it becomes it may not be real, but it becomes real. So anyways, it's been really good right now because we just had a person from the Bay Area. We coached him through doing who sold his house in San Mateo on Guilford Lane he listed it for 1.3, he sold it for 1.45. That's not a bad 10% higher in price. And he turned around and he bought 9 houses brand new from us here in our Central Texas market.
Wow. So
he tripled his income. So he went from a $3,200 a month income on that to about the total gross income on those properties over $13,000. So, and he did it tax deferred, which means he didn't pay any income taxes that he would have paid if he sold it on just a straight out sale. He would have paid hundreds of thousands of dollars. And so that's what we coached him through. And that's kind of what we coach. We try to not everybody can buy 10 houses all at once, but our idea is to help people buy one house a year for 10 years and pay them off in 20. You'll be financially free. They'll be free and clear. 10 properties. In our market, the values double about every 15 to 20 years. So the values of what you purchased would be worth double. So if you bought $2 million of property in the first 10 years and you paid it off over 20, it's probably going to be worth about $4 million, and it's free and clear, and it's throwing off about $15,000 to $20,000 a month. That's pretty easy for a lot of clients to do, to buy one a year or more. We have people come in and buy multiples. And so it's a lot of fun.
But they need to know how to do it. And
Absolutely.
That's going back to our very start of this conversation. It's the knowledge that people need, and that's what you're there for.
Yes, and it's the knowledge. It's it's the market research. It's where to throw the dart. And we have great relationships, and we'll talk about in the next podcast about how we do our research and where we throw the dart, and what segment of the market are we looking at. I don't do fixing and flipping a lot, because for me, I don't have the time to do it, and there's too much money chasing too few deals out there. I'm just get rich consistently, right? Just buy and hold, and I'll do fixing and flipping or just flipping. I've done dozens of those myself, but it's not a model that I try to get, especially people from out of state, try to get involved in doing a renovation job. That's a full-time job.
Absolutely.
So our strategy is to help not only first-time home buyers and move-up home buyers right here in our typical residential real estate market. I'm a broker, been a broker for 35 years. We still help the move-ups and the move-downs, and a lot of even first-timers that people don't want to. It's a segment of the market that a lot of realtors don't want to focus on, but I find it's great because I do a lot of education, and then the investors, because it's exciting to see what they can come out and get for their money. Even a lot of local investors are buying. They get it. And I teach my clients, if I can't figure out the numbers on a napkin, then it's too complicated for me. I want to just go back to that theory that if I just bought one house every 10 years, and I'm up over 10 now, and now my wife's going to get another 10, and my goal is 48. And then the exit strategy in 3 years, which I'm quarter of the way there. But my exit strategy is to turn the 48 houses into 450 units, to 10 exit and go into apartments through apartment purchasing or syndication. So it's a end to a means as well. Or I can just hold on to them and live off the 48 properties will bring me in about $22,000 net cash per month. So.
Just make sure your wife doesn't spend 25.
Yeah, or don't go buy $1 million house with $1 million loan if your income is based on real estate. So, but no, that was my lesson. The reason I bring that up is because a lot of people say, "Oh, you've always been successful," and it's like, yeah, you know what? I've had my struggles too, but you know what? We come out with our standing on our own 2 feet, and it's still going on these days. I mean, we sold the house after 7 years, and so we didn't lose money on it. We didn't gain money, but paying $7,000 a month, that I'd much rather have $7,000 a month coming in off my 10 rental properties, right? But don't limit yourself. We can, if it's just 1 or 2 or 5 or 7 or 10, and then knowing where to throw it and having the proper team, the acquisition team, which is us, and then the leasing team, which is us, and then the management team, which we farm out to our expert management companies, which is key for long-term investing is management, and then disposition one day. So and that's a lot of our clients that I'm selling right now, listings that I have are people that bought 10 or 15 years ago that are ready to do something different with their property. So all said and done, we want to help you sell it one day, and that's what. And we also want you to have a good experience, like that's what we said, having fun with this, and growing with it, and we're building a culture around it, and so we want our podcast listeners to be part of our culture.
Kenn, good stuff. What do we have coming up on our next episode?
Okay, so the next one we're going to study a little bit about the cycles. We talked about it on my Rich Dad, Poor Dad story last time, but we're going to talk a little bit about the cycles and the counter cycles of the real estate market and how that affects your long-term investment strategy, and then where to throw the dart. That's the big question that we always get. Okay, I'm ready to do this, but I want to plug into your process and your team and everything, but where should I buy, and where I'm going to have the best chance of appreciation we look at demographics, geographics. We're looking for education, good schools. We're looking for great employment opportunities. Jobs drive everything. So we're going to cover that in our next podcast. So subscribe on iTunes or wherever you may get this podcast.
Real Estate 360 is produced by Good Morning Meg Media, Austin, Texas.